Ladies and gentlemen, a brand new research report from Bank of America just dropped covering SoFi stock. Let's go ahead and read it. We have a lot to cover. I actually just lied there. It's not that long, but let's go through because every single line that they put in here is important. So, we believe investors will be the most focused on growth in the financial services and technology segments. Very interesting considering a lot of the very bearish and negative reports that we see on SoFi are only covering the lending segment. But then looking at different analysts, you can see they're almost entirely focused on other segments while lending is sort of staying stagnant this quarter. Anyway, in our view, there is less concern about SoFi reaching revenue and EBITDA guidance given the company's history of beat and raises, which obviously, if you guys don't know, if you're new to SoFi, every single quarter that they have an earnings result, they either go above and beyond their midpoint of their guidance, but even more than that, they usually even beat out their top line every single time since they've been a public company on all, revenue, EBITDA, and net income now that they're positive. For financial services, investors will want to see robust product growth and further monetization of users on the platform. Technology growth is expected to ramp up in the second half of 2024, given growth targets and commentary on requests for proposal timelines or RFPs. So, this is what they're talking about here is that essentially SoFi has said they are going to grow year over year from full year 2023 to full year 2024 about 18% on their technology platform, well 16 to 18%, and yet we really haven't seen that at all. It's been all single digits, so there should be quite a large ramp up considering we only have 2 quarters left, so that'll be quite interesting. But what is in the forecast and consensus? So for adjusted revenue, EBITDA, and net income, it's as follows. 641 million for revenue, 170 million for EBITDA, and net income of 44 million. They are generally above the consensus, which is 631, 166, and 41 respectively. So higher across the board. Our estimates are on the high end of the revenue guidance, net income guidance, and we're a touch above EBITDA. So this is what SoFi's total guidance is. Consensus is even lower on the revenue side, which is just crazy. Wall Street thinks they're going to get in less revenue than the midpoint of their guidance. Never has happened. More EBITDA, and then, just shy on the net income side. My predictions is what they do every single quarter. Okay. So $649 million worth of revenue, 172 million of EBITDA, and 50 million of net income, which will bring in roughly just about 5 cents of EPS, which is just a little bit above their target, which is what the whole article is written about. Going back to segment contribution, for lending, our forecast is $339 million. I put mine here, Future Investing's Guide, 352 million, slightly above consensus of 334. There has been just so much talk around the actual lending side, potentially because the rate cuts are here. I think that they're going to see a large boost in home loans, student loans, and personal loans are still going to be doing well. I think that we're going to see a lot of selling this quarter. So my opinion, we're actually going to see a much larger boost in lending, and just like them, primarily due to a higher non-interest income. Anyway, and by the way, if they can sell more, that means that they can originate more, which is just going to make this sort of a vicious cycle, which is good for them. Our financial services revenue is expected to go to 212 million. I'm at 209 million, actually, slightly lower than theirs, and guidance is at about 206 million. The reason why I'm closer to this consensus here among Wall Street is just the ramp up in financial services has been pretty, I don't want to say slow. It has not been slow, but it's been pretty consistent, I would say. And the thing about the 212, and it's very hard for me to get there, is that would need to be driven by some sort of products that are bringing in more revenue than they were before. So, potentially Invest sees a really high spike up in users, or potentially credit cards start to boom. So I do suspect both of those things happening. I'll cover that in the next video, but not to the degree where it's going to be like where I can see myself above their estimates. I actually just am comfortably putting it at 209. And anyway, our technology revenue forecast of 105 is in line with the street. I'm actually at 108, but that's just because of the member growth that I had on it, which is just slightly more than last quarter. Contribution margins are generally in line, except for technology, where we are at 30% below the street at 36%. on originations, they said our total origination volume is estimated to be 5.4 billion. I actually put mine at 5.6 billion, which is extremely bullish comparatively to the Wall Street that's saying 5.1 billion. But with the rate cuts coming, like I said, vicious cycle. I think that it's going to be a huge selling quarter, and they are going to refill that with more originations. Driven primarily from higher personal loan growth. I think it'll be growth across all three sectors, especially home loans are going to surprise people. We note that despite the company taking a more conservative stance on underwriting, originations in second quarter exceeded street expectations by 25%. That would be an extra, essentially one extra $1 billion or 6.2-ish billion on top of what they're already doing, which is just insane. Anyway, not an extra 6.2, but it would be 6.2 billion in originations this quarter. They just write this all out, so it's easy to digest. I thought I'd include mine as well. Let's just go ahead and zoom that in for everyone. So diluted EPS, I stick out a little bit here. Adjusted net revenue, I am slightly higher than B of A and just very slightly higher than SoFi's top line, which was 645. 647 is where I'm placing it at. Adjusted EBITDA, I am just slightly higher than B of A, and adjusted EBITDA margin at 26.5%, just slightly higher as well. Now for segment level info, and by the way, we're going to be doing for our next video, breaking this down completely. So you're going to be able to see how I'm getting to this adjusted EBITDA number, the revenues, the net incomes and everything. So it's not just look like it's, pulled out of a hat. It'll be very similar to what we did last quarter, which is actually pretty similar to what we actually saw in the real numbers. But I actually added a little bit more details to help just make it a little bit more specific for everyone, including myself. Okay, segment financials. So you can see higher in lending by quite a large bit. This is really where I'm going to see a large amount of the increase here. Financial services, I'm not as excited as B of A. However, I'll take it if it comes. And just slightly more positive on technology platform because we have to get to that 18%. I don't know how else we're going to do that if that doesn't happen within the next 2 quarters. All right. So that is the report. Very quick and simple. B of A showing a higher report than the rest of Wall Street. They have a current $9 price target on the stock. However, that was written back in July. So maybe they make a change in the stock price. Maybe that comes after Q3. But so far, the market is loving SoFi, and we're expecting really good things for Q3. Anyways, guys, if you like this sort of content, make sure you subscribe down below. But until next time, bye for now.